in crypto, like to say that the institutions have been coming for a while. 𝗀𝗡𝗅 dared me to compare this to the 𝗵𝗶𝗃𝗃, the British are coming quote, but we've been saying it for a really long time.
That's one way of, how do we bring, I guess, merge the two worlds. And if we can't quickly bring, CeFi to DeFi, maybe we bring DeFi to CeFi, right?
For example, there was rumors of Tom Lee buying call options instead of buying spot Ethereum. Right now, I'm not going to say that those are substantiated, but
And now, as we go longer and longer, they actually have a higher chance of survival.
welcome back to the Rollup. We are your hosts. I'm Andy.
I'm Robbie, and this is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Guys, welcome to the stream. Good to have you guys.
Yeah, likewise.
Thanks for having us.
It's a busy time out there. Hope you guys had a good Labor Day weekend.
We were hoping for a quiet August, but that was not the case, was it, 𝗀𝗡𝗅?
No, it doesn't feel like a summer at all. It's been getting wall cross on DATs all summer and weekend.
Yeah, man. So I've been spending quite a bit of time out here with a friend who runs pretty prominent VC in the space, and just kind of like seeing how he was working through August, and knowing that August is like a really slow month on the institutional side. Him and I were just kind of talking about what some of the larger investors on Wall Street, some of these Ethereum DAT investors, et cetera, are going to be doing now that September's here. And our theory, and we spoke with the framework guys last week, we basically have came to that there's going to be just a massive pickup in activity on the DAT side, on the ETFs, on the institutional flows. How are you guys thinking about this? And what are you guys seeing? And maybe first, we haven't gotten an intro, so I would just love to know, first time on the show, guys, quick intro, and then I'd love to just jump in as to what you guys think the next couple weeks of September have in store on the institutional side after a not so sleepy August. Aya, maybe you can go first, and then Shiliang. Guys, thanks for joining.
Sounds good. Yeah, thanks again for having both of us. Having worked with 𝗀𝗡𝗅 in the space for such a long time, it's always great to be able to trade industry notes on a call like this. So appreciate you both for hosting. My quick background: so have been in the space for a bit, formerly part of the 𝗵𝗃𝗃 team, and then part of the founding team of FalconX, a CeFi crime broker, which 𝗀𝗡𝗅 will also speak to. And now co-founder and co-CEO of August and Upshift. August is our institutional prime business for DeFi and CeFi, and Upshift is our yield platform. And as it pertains to August and September, I will mirror what 𝗀𝗡𝗅 said in that, August was not the slow month we were expecting. There's kind of two divides that I would take this, and 𝗀𝗡𝗅 has a lot of more context on this, so I'd love to get his thoughts too. But the feedback we've gotten is everyone has a limited attention span, so you can only send so many DATs and so many of these digital, these treasury-like products to the same type of roadshows before people start to look for different yield opportunities. And it certainly feels like we might be at the tail end of that trend. And so while it has been a very busy August, I think the next question is, what's the next yield product for September to kick us off with? There's that. And then there's also, the conference kickoff that crypto tends to see with Token 2049 really kicking off the circuit. And so, that tends to also jumpstart a lot of the conversations on the product and partnership side too.
Introducing Extended, exclusively on Starknet, a next-gen perps trading platform live today. With 50-plus trading pairs from crypto to TradFi, you get the best experience on-chain today. Deposit in the community vault for attractive returns, EMV compatible, and engage in unified margin, spot trading, lending, and perps trading. Exclusively live at extended.app on Starknet today.
Yeah, just to step in there. So thanks for having me. But I'm 𝗀𝗡𝗅. I used to run a hedge fund called Ledger Prime, like a multi-strategy hedge fund. And then subsequently started another firm called August Markets, which was acquired by FalconX. And my current fund Monarq, which is rebranded to Monarq from 𝗵𝗶𝗶𝗵, and it's a relaunch of Ledger Prime, was also majority acquired by Falcon X. So basically, we're an asset management firm. It's a multi-strategy, largely crypto-focused fund, although more recently we've been doing a lot more traditional crypto-related equities. Yeah, and I just echo what Io says. Definitely in August, July, August, extremely busy on these DATs. For us, we invest, and so we do a lot of due diligence on them, and a lot of that due diligence happens on weekends when you get wall cross on these vehicles, and then subsequently we also manage the treasuries for a handful of these DATs as well. And so post deal execution, as you're accumulating these assets or hitting the ATM and doing subsequent shelves, will help them accumulate more, right? And so it's been kind of two prongs there, which has kept us pretty busy. And yeah, I would say sitting in New York and in the US, it certainly felt like the DAT trade has been going on for a long time. But at the same time, I think abroad, especially on Asia, they've been a bit slower on the pickup, especially at the founding stages. And we're starting to see some of the later DATs that they're all ongoing now, actually, being predominantly Asian capital, just because they were kind of left out or weren't all the original ones to begin with. There's like a Athena one, Solana one. There's a lot of Asian capital actually flowing in now to these later ones. And so, there's a bit of exhaustion from the US side, but I think globally there's still a lot of capital and attention that can be harvested for these vehicles.
When you're describing sort of the later nature of these DATs, how do you reconcile this in terms of the investability, right? Like the sustainability of these treasury companies. Is there general macro policies or any sort of liquidity conditions, any sort of drivers that you can point to outside of the DAT structure itself that can show you, okay, this is sustainable, or no, this is something that is really just piggybacking and it's copying these other formats? What are some of the drivers that you look at that are going to indicate to you this is something that's sustainable and this is something that still has some legs to it versus the alternative?
Yeah, I think it's definitely case by case, right? I think one is the shell, right? If you're going to do a pipe, like how clean is the shell? Is there like a dirty legacy business? Is there a lot of warrants and converts associated with it that can make your stock harder to trade later down the line? Is there like a lot of liquidity actually in the stock already? And then obviously the coming in, like the management team, right? Like that's a lot of this is kind of like a marketing game. And how do you grab the attention of the public markets? And you need someone that can bridge a gap between crypto and institutions, right? And I think Tom Lee and Bitmine has done a great job of that. But some of the other vehicles that are less known and whatnot, I think I've had a tougher time, right? And so there's a lot of different factors, right? And obviously Bitcoin and Ethereum I think are large enough and well known enough to sustain many vehicles, right? But some of the other tokens, lesser known tokens, lesser known in the traditional institutional world, I think it's gonna be hard for them to sustain 2, 3, 4 vehicles, right? And so that's gonna be, I think, a problem down the line. So it is case by case, ecosystem by ecosystem. For us in terms of how we analyze it.
I had anything to add there?
Yeah, I mean, I would just really anchor on the attention piece because, how many Bitcoin and ETH treasuries, could possibly exist out there. And it's not unique to DATs per se. It's for any product that is either first to market or has, a very marketable, name to it, like bullish, that really speaks to the retail Robinhood trading crowd. And so it is very much a marketing game. And To Shilang's point, there are some organizations that have done a tremendous job of it. And then there's others that, maybe have marketed themselves really well. But all of the factors that Shilang just mentioned are very poor on the back end: management team, structuring. And unfortunately, I'm sure those will have a much shorter lifespan because, not everyone is good at managing money. And it works well when prices are up and to the right. But if we do have a lot of volatility come up, I think it'll be very interesting to see, how these play out, given who the manager is across each of these structures.
Yeah. I think one of the things that is most interesting from our perspective, and I think a lot of our audience, is around the actual using of, specifically Ethereum and also Solana in their respective ecosystems to generate yield and to provide basically more ways to keep the mNAV higher, than or keep the premium you kind of rolling, right? Robbie and I got our start in early 2020. We were, we were some of the first on Yearn, on Compound. We were very much in the trenches, so have a good feel for yield farming and just kind of generating yield. I'm curious, when you're speaking with your prime brokerage business or on Upshift, kind of how you're thinking about providing these offerings to either these DATCos, ETFs, kind of like what interest are you seeing? Is there a specific way in which these institutions need to operate on chain? How are you kind of seeing this play out?
Yeah. First off, it's good to know you were in the DeFi blue chip summer. That was a fun one. Definitely
As well.
get off your phone. Yes, yes, that was a good one. That was wild. Those your days were good days. But yeah, I would say, look, a couple things need to happen. The first is, we in crypto like to say that the institutions have been coming for a while. Shilang dared me to compare this to the Paul Revere, the British are coming quote, but we've been saying it for a really long time. And, the reason they haven't been able to come just yet is because we're still, we're still getting NAV and reporting organized to a way that, someone can easily review what an APY looks like without having to, click through a number of different wallets and, compare different Excel spreadsheets. So that's the first. The second is Oracle redundancy, smart contract security and underwriting. And then the last I would say is security, right? And I think this is where we built our business coming out of the FTX days, where we wanted to have a more secure DeFi ecosystem that allows you to do CeFi like trading, but with all the tools and provisions that CeFi extends into DeFi. And so, when you have these kind of treasuries set up, you typically have them structured as SMAs. You have different managers who want to control exactly how they trade, where they trade. And today, that doesn't really exist on chain. And so that's a gap that we've been able to fill. But it is, still a very long road. I think it takes time to get people warmed up to, trading on chain, having it be, fully transparent. And then also just the operational lift. We're still not there yet where you can one-click DeFi trade, unfortunately. And that's just because the technology is, very, very difficult. It changes every single day. And you just, new chains pop up, new dApps pop up, new loops pop up, yield changes. And yeah, so, protocols are managing for that.
Yeah. Shilling, do you have anything to add there? Maybe with regards to what some of your institutional clients' appetite is?
Yeah, I think we've always been very active in DeFi, and I think that's been our edge to a certain extent, right? I think we're a smaller fund, less regulated than some of the traditional players, and so I've always been able to access DeFi directly. I would say, like, broadly, regulation held back DeFi access to a certain extent, as well as infrastructure. I think regulation is broadly getting lifted now, right? And whether you want to call this era of deregulation or regulatory clarity, it does like open the floodgates to just increasing competition and mind share and access. And so I think generally the blocker isn't now just purely regulation. It's actually like infrastructure, right? It's like, I think people underestimate how much infrastructure has actually been built in DeFi, and then also for traditional institutions, how slowly they actually move as well. And so even if they could have wanted to, I think it does take just a tremendous amount of lift to um, integrate with all the different platforms, service all the different customers if they want to touch DeFi, and something as simple as cross collateralization of assets and portfolios between CeFi assets, traditional assets, on-chain assets. While it sounds like simple and kind of like the ultimate North Star, it's pretty hard to set up, right? And that's something that firms like August and Upshift are building. But for traditional firms, right, it's extremely difficult. And one example of something that we're actually working on right now with some of the traditional bankers and shell entities is how do we bring like yield bearing products like to the traditional world, right? Like right now, like absent of going directly, and touch DeFi themselves, which some firms still can't for KYC or AML and regulatory purposes. They can do it through an SPV or they can do it through like a total return swap, be like a income passback method. Both aren't really like elegant. It's cumbersome. So something that we're actually trying and borrowing from the DAT world is, maybe there's a way to use like depository receipts, right? And RDC is a firm that basically can bring depository receipts from a qualified custodian, basically turn any yield bearing token into a DR that can be held in now traditional rails like a PB. And just by acting as a holding vehicle, you actually get a yield bearing depository receipt that can also be traded and used as collateral in the traditional world and rails of traditional PBs, and using that as collateral to trade stocks and bonds and everything else, right? And there's a bit of lift there as well in terms of getting the necessary liquidity and prime brokers comfortable with yield bearing tokens. But that's one way of how do we bring, I guess, merge the two worlds. And if we can't quickly bring CeFi to DeFi, maybe we bring DeFi to CeFi, right? So those are some examples.
Like the original vision here was that we would all run our own validators, we would all verify the chain ourselves, right? Like I remember when I first opened up a wallet back in those DeFi blue chip days, I had to run a full node at the same time just to own a wallet. But what we're starting to get to is more of this institutional foothold in owning pieces of these networks. And so I'm curious where this end game develops, maybe on like, a sort of a midterm time horizon, as we're increasingly seeing that retail does not want to run their own node. They don't even really want to know that they're using crypto. We're going to start to see institutional institutions take a greater foothold in these networks. And so I'm curious, when you kind of forecast this out, and Bitmine owns 5% of the Ethereum supply, and SharpLink owns another 3 or 4%, and Michael Saylor and MicroStrategy own, a larger percent of the Bitcoin supply. Would you guys say does this pose a systemic risk to these networks, or can it become kind of this funnel and this outlet for the greater population to engage with the network from a more secure, more convenient place?
Ooh, Shiliang, I'll let you take that one first. Definitely have thoughts.
Yeah, I think there's like two. One is like, is this all in the spirit of what crypto originally like represented?
I don't know, man. Is it?
It's kind of like, yeah, like the whole like original like Bitcoin saying like not your keys, not your coin, right? Like it's clearly not. But it is what will bring ultimate mass adoption. At least, so you can think of it in terms of like stages, right? Having institutions hold their gold keys and custody and everything probably is a heavy lift, or just the average retail even. And so I would like to think that we will progress we are progressing to the stage where it is more centralization and mass adoption, and getting everyone comfortable and using the rails and exchanging and everything. And there will be some point, after that where now that everyone is onboarded, it doesn't mean that 5% is a lot, but at the same time, it's not even close to the majority, right? And so I think there is a world where, bifurcated world where you have the institutions and it's very centralized, but you still have kind of the self-serving, um, individualistic kind of, world that crypto originally represented. And I don't see why the two can't coexist.
Yeah, I would just say, I think relative to how much Bitcoin some of the OG holders already own, we've already reached, some concerns around centralization. And so, to Shilang's point, I don't think these large institutions pose any net new risk that didn't already exist in the kind of pre-mass institutional stage. I would say the risk that it does pose is, volatility and price risk. If any one of these players takes on large leverage and gets liquidated, that brings us back to a kind of Black Friday event that we've seen in the past that will require centralized stopgaps again to kind of save the industry. And so I actually think, I tend to sit in the camp where centralization, there's definitely some benefits to it, but also, August was born out of FTX, and there's definitely limitations to, how good centralization can be. And a lot of it is, people taking on significant risk without knowing how to underwrite that risk. And we're actually seeing that happen again. And even if you think about what was the trading experience like when you all traded in 2020 over the last 5 years, I can't say that the experience has gotten that much better, unfortunately. And it's just because the technology is really hard. And I think people undersell just how long it takes to build a seamless user experience on, fully open code. And you know, that then leads to people wanting to cut corners. And unfortunately, I think what we've seen is in 2020, when we started the business, we had a lot of requests for risk mitigated features. And now we're actually seeing a lot of requests for people to cut those corners and be able to do things in a much more seamless way with less checks and balances in place. And, I think the only thing that keeps that in check is just large black swan events, unfortunately. And so, will we have another one? Yes, always. Ideally, it doesn't happen from one of these large institutions that's holding, 4 or 5% of any, specific asset, whether it's Bitcoin, ETH, or any of these other altcoins. But it's bound to happen, whether it's one of these centralized parties or an exchange or some other large 3AC like hedge fund. It's gonna happen again.
Yeah. Yeah, I mean, I think if we think about some of the larger risks for the current bull run, I mean, I think obviously there's like the macro factors, something like inflation going up too high, these types of things. But I think there's also like now these systemic kind of DATs that are people are kind of worried about. But it does seem like there's a bit more of there's a lot more concern with what is actually happening publicly now, likely as a result of like PTSD from previous cycles, but also just that this has been so public. So from my perspective, it's almost like, well, if everyone's already clearly stating that this is going to be risky and that this could, cause problems, then perhaps it's less likely to actually really play out in that way. But I'm not sure if you guys have seen this, and Shilling, I'm super curious from your perspective. I know that you're deep in the DAT land. Like, has the DAT structures gone from like where they had originally started, which was like more of like, I think, if I'm not mistaken, more of like pipes, then they brought pipes and at the monies, then they've kind of, have they gone more and more riskier, like almost like a senior tranche all the way to like a junior tranche, to kind of try to get more yield, try to get more premium? Like, are you seeing the risk tolerance go up? Like, for example, there was rumors of Tom Lee buying call options instead of buying spot Ethereum. Right now, I'm not going to say that those are substantiated, but the question is kind of like is that process gradually happening? Because if it is, then I think we may have that kind of black swan as Ilya or as Aya presented, at least as a possibility.
Yeah, I like to think, that the buy and call strategy as actually just smart execution.
All right, we got a DJ on our hands here.
He's an option trader. He's an option trader. So just keep that in mind.
language.
It's definitely happening. Not saying BitMine is doing it, but it's definitely happening across the space.
As like a hedge or as like a way to get more upside or both?
It's a way to get more upside.
Oh,
So, right, like one way to watch for it is, if you know you're going to buy a certain token, and you think you're gonna, ultimately drive the token higher, like you can buy a call option ahead of it, right? As one way to kind of like amass additional tokens and get additional leverage, because like ultimately, if it finishes in the money, you exercise them and you basically buy the tokens at a lower strike as long as spot is above it, right? I think it would get dangerous if they were selling options on leverage, right? I think like that's where firms ultimately blow up, right? If you're buying, your kind of your downside is kind of just a premium spent. But if you're like ultimately, selling options eventually on leverage for yield, because ultimately the MNAV premiums for all these vehicles are going to deflate out, right? And I think, the majority of them will trade at par or at a discount, right? And maybe the top ones in high growth, native yield generating, tokens and their associated debts, maybe they trade at like a 25 to 50% premium, in the long term, right? I think, the majority are going to deflate away, right? And so, then to differentiate or to survive or generate additional revenue or cash flow to basically, continue buying the underlying tokens, that they resort to esoteric yield generating strategies or, things on leverage or, basically running a fund, right? And they don't have the proper knowledge or expertise to do that and run these, more sophisticated strategies,
Yeah.
then they run the risk of obviously blowing up, and ultimately bring down, the whole, individual entity and obviously, the space if multiple are doing at the same time.
Yeah.
Now,
Just a real quick follow-up there, Rob, just one last one.
yeah.
So September 19th, I believe, is a massive expirations date for options for Bitcoin and I believe for Ethereum. Showing maybe you can double check me on that if you're familiar. I'm just curious, like more in the short term here in September, what is the options market kind of telling you from like an IV perspective or just from a risk parameter perspective?
Yeah, I mean, there's a few events, right? Like even this week, there's been a bit of vol premium to it. Right? I think there was an ISM today, and then there's employment data coming out on Friday. And then those are kind of the drivers of ultimately later on in the month for the Fed rate decision. So all that is getting priced into the options markets as events that can move the market, and so the options market is obviously priced in event vol for all these different events, and obviously the big one is the Fed funds decision later in the month, right? And even though it's priced in, I think the not the amount and whether they actually cut or not. It's more about the Fed funds constant at the words and how he vents the ultimate rate cut and everything there, right? So the market is definitely pricing more volatility in September than previously.
Nice. I got a couple quick ones before we let you go. One is that my understanding of these DATs is that the cost of setting them up occurs upfront. And so to me that says, okay, well, the longer that these companies survive, the less their operating expenditure is, if most of their costs occur upfront and they're not recurring. And so is there a Lindy effect to these? Maybe SharpLink and MicroStrategy, they've been around for a long time. The newer ones that come up a little bit later aren't going to have as much time to sort of dilute those initial expenses. But some of the ones that, we saw start months ago, BitMine, SharpLink, are maybe, 3-4 months old, still relatively early, but have they had a chance to get through some of that initial expenditure? And now as we go longer and longer, they actually have a higher chance of survival?
Yeah, I would say, I mean, I don't think fees ultimately, it's kind of like fees and even yield to a certain extent. Like people talk about, okay, like, how do you generate yield in the assets? Like 5%. Like that's not really going to move the needle for like whether these things survive. Like 5% yield, great. Like it's not going to like really bring additional like retail capital to these vehicles, right? And same with fees. And there's ways to mitigate fees also. Like one is investment banking fees have come down tremendously in the past, 3 months, right? From a lot of these vehicles to the asset management fees as well in like the past 3 months. Um, and then there's ways to mitigate that, right? Like you have a 1-for-1 like staple warrant to these vehicles. Like, a lot of these vehicles do this now is, if the kind of baseline MNAV is like 1.2, so it's basically like 20% below, but like you just throw like either like discounted tokens into it or you throw like a warrant on top of it, and basically that kind of just lowers the whole NAV down to like 1, right? It's not like, it's kind of artificial, right? Because like the warrant's ultimately diluted and it's like a share dividend, but um, you know, there's ways to kind of like mitigate that. I don't think it's important, right? And people should ask these questions: is management aligned? Like how much upfront fees there is and everything else. But I don't think that ultimately all of that drives whether these things survive or not, right, in the long term.
Got it. And the other follow-up I had was that earlier we were talking about MicroStrategy now checking the boxes and meeting the criteria for the S&P. They have a decision later this month to take out some companies from the index, put some new companies in the index. One, do you think this happens either now or sometime in the near future? And two, if it happens, will we see some sort of on switch flip and, see some liquidity rush in as these passive funds, are accumulating the S&P? What do you think is the domino effect of bringing MicroStrategy or another one of these DATs into the S&P?
Yeah, I think it's, I hope so. I think it will get included. Yeah, I think it will get included, and I certainly hope so. And a lot of the success of these vehicles has been on the volatility, right? And hopefully, at least in the short term, getting included in the S&P drives additional interest and price action and increased volatility. And so it enables, MicroStrategy or anyone else um, to harvest that, right? And kind of, generate additional yield and cash to accumulate additional tokens. And so I hope that happens. I think, if it happens, it drives additional volatility, and ultimately it's good for DATs, it's good for tokens, and it's good for the space, at least in the short term.
Yeah, do you want to add anything there?
Yeah, I mean, again, like this all looks great as long as price is up and to the right, you know. Volatility is not always up and to the right. And so, as and I agree, I think it'll get included in the S&P 500, but that also means that you can, take on additional leverage. And, there is pretty large systemic risk in, the vol of Bitcoin relative to, um, the structure that MicroStrategy has running. I think that in itself is kind of the black swan we don't love to talk about in the industry, but is very, very much there. And so, I think it's great for the space. It'll be hopefully good also for inclusion of non-US funds once it's in the S&P 500 as well, just on a marketing basis. But yeah, overall great for the space. I will say the one thing that we have seen is to Shilling's earlier point, there hasn't been that much volatility and interesting yield opportunities in the last 2 months. And it'll be interesting to see if September kind of changes that around. But to take on significant risk to earn 5%, which is kind of the call it risk-free rate, doesn't necessarily make sense. And so, at some point, people will have to potentially offset, costs by going into more esoteric yield strategies. And that's again, like talking about risk, that's where the risk is, and whether people can manage that well.
Yeah. I just want to give you a chance to shoot your shot here. Where can people find you? Where can people use Upshift? Who are you looking for as we close out?
Yeah, of course. So we actually have Monarq as one of our one of our curators on the Upshift platform. You can check us out at upshift.finance. I would say, a lot of what we focus on is, everything that we mentioned on the call today is mitigation of risk, right? And it's easy to look like, you guys know this well, coming from 2020, it's easy to look like you're a good trader when the market's doing well, and then really complex when you start to get that volatility. So as we do expect vol to increase in September, and Q3 tends to be a very volatile quarter for crypto in general, we definitely want to see, professional managers and curators manage that risk. So check us out.
Guys, thank you for joining us. It's been a pleasure. I find this meta of the conversation of the cycle to be relatively interesting as it's new information, but also kind of like, I don't know if it's as exciting as winding up algorithmic stablecoins on weird collateral, or super
Boy.
crazy lending. But it is what we got this time around.
Look, all of that's going to be included in these DATs soon enough. So, it will converge. It will converge.
Yeah, Shiliang, stay safe out there in those options territories, man. Burn me once, burn me twice. Shame on me, shame on you.
Thanks.
Yeah, thank you guys.
Thanks for joining, guys. We'll see you next
Thanks,
time.
guys.
See you soon.
Really appreciate it. See you.
Cheers.